Hi, welcome back to Joe Blogs. In this episode, I want to talk about China's debt crisis. So in today's video, I'm going to go through the Belt and Road Initiative. We'll have a look at exactly what it is, what countries China have been investing into, and I'll give you a heads up that the biggest single exposure on the Belt and Road Initiative is to Russia. And I think that's probably a surprise for most people watching because you assume that the Belt and Road Initiative has gone to emerging and underdeveloped countries who needed to develop their own infrastructure. But actually what's been happening is a lot of money from the Belt and Road Initiative has been going into oil and gas and other energy initiatives. And obviously Russia has a lot of natural resources, so China has been investing heavily into Russia. And one of the problems that China has right now is that the credit risk for Russia has gone off the scale because they've lost so many of the markets that they were selling into. The West has now sanctioned Russia. There are a lot of countries who no longer want to buy any of Russia's products. And as a result of the sanctions, the debt rating for Russia has been downgraded and the risk has increased. So in today's video, I'll have a look at the exposure that China has through its Belt and Road Initiative. We'll have a look at what's been happening to those loans, what's happening to the risk profile, what's going on with regards to inflows and outflows of capital from China. We'll have a look at which loans are in distress. We'll then spend a little bit of time looking at Russia specifically. And then finally today I'll finish off with my summary. So what I think is likely to happen to the huge amount of debt that China has out all over the world and what the risks are for both China's economy and the global economy. China's Belt and Road Initiative was first announced in 2013 and is a global infrastructure development strategy to develop two new trade routes connecting China with the rest of the world. The initial focus has been infrastructure investment in 68 countries in a bid to enhance regional connectivity and embrace a brighter future. The Belt and Road Initiative refers to the geographical areas of the historic Silk Road trade route. It's estimated that over the next 10 years, the Belt and Road Initiative will add around $1 trillion of outward funding to foreign infrastructure. This map shows the location of some of the current projects, which include Sri Lanka, Malaysia, Cambodia, Pakistan, Kenya and Greece. When you think of the phrase Belt and Road Initiative, I think the initial thought is that you assume that China is investing into road and rail and infrastructure that will join up all of the dots, that will give them this road that goes from east to west and gives new access to new markets throughout the whole of the globe. But when you look at what China has actually been investing into, the majority of the money has been invested into energy. This chart shows the percentage breakdown of the sectors that China has been investing into directly since the Belt and Road Initiative was launched in 2013. And the orange sector, which is by far the largest in every single year, represents energy products. And you can see that in the first year of investment, energy products represented more than 50% of all of the money put out the door by China. And whilst that percentage has come down in subsequent years, in 2020, the amount of money being invested into energy still represented over 42%. So by far the largest amount of any sector. The next single largest investment sector was transport, which represented around 16.5% back in 2013 and 31% in 2020. The development of commodity metals has been the next largest investment, and this is the yellow section. And the fourth largest sector that China has invested into is real estate. And a lot of that money has been invested into the construction of new real estate in many countries around the world using Chinese contractors and employees. So the usual form of the contracts for the Belt and Road Initiative is that Chinese companies will be employed to design and build the project, and Chinese employees will be shipped over directly from China, will complete the build and will then go back to China. So this was essentially a way of providing guaranteed work to a lot of Chinese companies and employees. So just to recap before we leave this table, a lot of the investment that China has been making into overseas countries has been focused on the development of energy products and metals. In 2013, these two sectors combined equated to around 57% of all the investment. And by 2020, that figure was still above 50%. And one of the drivers for this form of investment was to ensure that China developed strong relationships with the countries that owned these natural resources in order to develop that sector in the country, but also to make sure that China could get access to these products going forward. This chart shows China's exposure by country for the Belt and Road Initiative investments. And you can see that the biggest single exposure that China has right now is to Russia with around $300 billion. The next largest country that China has invested into is Qatar with around $250 billion. And the other countries on this list that have high amounts of valuable natural resources are Saudi Arabia, where the exposure is around $100 billion, United Arab Emirates with around $75 billion, and Nigeria with around $60 billion. So I think what's really surprising here is that you would have assumed that the investment into the Belt and Road Initiative would have gone to the poorest countries in the world that needed the infrastructure building, and they needed the help and the expertise of the Chinese to come and do that for them. But what we're actually seeing is that a lot of the money from the Belt and Road Initiative have gone to countries that are actually rich in natural resources and actually are relatively advanced and wealthy. So China's really been looking to develop commercial relationships with a lot of these countries rather than just putting into place infrastructure that will help to develop this notional east to west road. But one of the problems that China has with regards to development of energy products is that these are very long-term investments. As you'll know if you follow the channel, it takes a long time and a lot of investment to build infrastructure to develop oil and gas facilities. And what we've seen in Russia is that the joint venture partners who came in at the start of the process, BP, Shell, ExxonMobil, have found that they've put in all of this money, and now Russia has ejected them from the country and taken ownership of those assets. Now, the Belt and Road Initiative investments only started around 10 years ago. So China is at the front end of this process. It takes a long period of time to recoup all of the investment that you put in for oil and gas and other forms of energy infrastructure. And the problem that China has right now is that a lot of the countries that they've been lending to are now being downgraded in terms of their debt risk. And China now faces the very real prospect of those countries not being able to maintain those loans. They may not be able to make the repayments. And also, they may not have sufficient capital and or expertise to be able to continue with those energy projects. So China's now at that pivotal moment of deciding whether or not it continues investing money into these countries to see these developments through to fruition and maybe get some return on their investment over a very long period, or walking away from these investments partway through and writing off all of the money. And if we jump back to this chart, I want to just pick out the other countries that I haven't mentioned yet. Egypt is a country that we've followed on the channel. It's in financial crisis right now. The country is in distress, and China has provided more than $100 billion worth of investment to Egypt. Turkey is a country that we've been following closely, and the investment level from China is at a similar level. And the third country on this chart that I've made a number of videos about is Pakistan. And we've got a similar situation in Pakistan. The country is out of currency and it's on the verge of collapse. So looking at the countries that China has invested the most money into, we have seen a significant increase in the credit risk since Russia's invasion of Ukraine. Obviously, Russia has deteriorated significantly, and that's the single largest exposure. But we've also seen a major shift in Egypt and Turkey and Pakistan. And the total amount of exposure that China has to all of those countries is in excess of $600 billion. And just to put that into perspective, that is double the amount of debt that Evergrande, the giant property developer, has. And Evergrande is the most indebted company in the world. So what we're looking at here is double the risk of the Evergrande exposure hitting the Chinese economy if it doesn't receive any of this money back. So the analysis that we've just looked at shows that the credit risk is increasing for China. The economies of many of the countries that they're lending to are in extreme difficulty. However, maybe that's not that surprising because we're sitting on the verge of a potential global recession. The Ukraine war has forced up the price of energy and food and commodities. We've got really high rates of inflation all across the globe right now. So maybe this is just a reflection of the times. If you follow the channel, you'll be familiar with the concept of rating agencies. And rating agencies are financial institutions who undertake analysis of companies and countries, and they give them a credit rating. And the best credit ratings that you get are usually AAA, and it goes right down through to non-investment grade and default status. And as the credit risk for a borrower, whether it be a company or a country, deteriorates, then the rating agencies will reduce their ratings. This table shows the average sovereign credit risk rating for 108 developing and emerging countries. The black line at the top represents the weighted average for emerging and developing countries as a whole, and the red line here looks at the countries that China has been lending to. The scale on the left-hand side of this chart represents the risk rating, with the best possible risk being at the top of the chart and the worst possible risk at the bottom. So if we look at what's happened over the last 18 years, you can see that initially the red line was below the black line, so that meant that when China started lending, it was lending to higher risk countries than the weighted average. However, that line did cross over briefly in 2006, but since that time, the risk weighting for Chinese debt has been below the average risk weighting for emerging and developing countries. And over the last 15 years or so, the differential between the two lines has got wider. So what this tells us is that the risk of the Chinese debt defaulting is significantly higher than the average risk for all emerging and developing countries. So basically, China have been advancing loans to countries that are at the higher risk end of the spectrum. And in terms of the impact of the Ukraine war, you can see that there has been a significant downturn in both of these lines since the start of 2022. But the differential between the risk for Chinese lending versus the market average is now significant. And the average risk weighting is now B-, which is just above non-investment grade and heading towards default level. So this is a serious concern for China. If it was lending on average to the market, then the risk rating would be somewhere between BB and BB-. But China is 3 points below that and is just sitting above default. So what this chart tells us is that China's debt book is in serious risk of going bad. This chart shows the share of cumulative Chinese lending to developing countries that are in distress and includes all countries whose loans are in arrears or who have restructured debt with China or that are currently at war. So what this chart shows us is that up until 2014, less than 10% of all of the debt that China had lent to emerging and developing countries was in default. So 90% of the loan book was in good shape at that point. The sanctions that were applied against Venezuela from 2014 onwards started to have an impact on China's loan book, and by 2015 the percentage of distressed loans had risen to around 20%. That percentage remained relatively stable for the next couple of years. However, from 2018 onwards, we have seen a sharp increase in the percentage of Chinese loans in distress. The COVID pandemic obviously had a big impact as a lot of developing countries had to close down. We saw a lot of lockdowns. There was very little productivity. A lot of countries had to pay furlough schemes to their people. So it put a lot of strain on those economies. And that, of course, increased the risk profile. It meant that countries didn't have enough capital to be able to make their loan repayments. And so we saw more countries going into default. And by the end of 2021, the percentage of Chinese loans in distress was around 40%. And since the start of 2022, we have seen another significant increase in the percentage of loans in distress, and the total percentage is now close to 60%. So the total exposure that China has currently to the Belt and Road Initiative is somewhere in the region of $1.3 trillion, and around 60% of all of that debt is now in distress. So that means that those loans are no longer performing. China will not be receiving repayments. They won't be getting paid interest. So there's now a huge amount of pressure on China to restructure these loans. And the problem that China has right now is that a lot of these initiatives are semi-built. They haven't been completed. So China's now having to face the prospect of either continuing to invest to complete these projects, to see them through to their end game and then get them to generate some income, or walking away and writing off these loans. So it really is a difficult decision, particularly because the Chinese economy is now in difficulty, and so it's not able to access as much capital as it could 10 years ago. And to show the growing importance of China as a debt provider and also the massive amount of restructuring that China is now facing, let's have a look at a table which shows the number of restructurings that are currently ongoing with private lenders and the number that China are handling. This table dates back to the late 1970s and shows the number of distressed debt restructurings for countries that have been handled by private external creditors, so these are bondholders and banks, compared with what's happening right now with China. So you can see that up until 2000, China was not involved in any distressed debt restructurings at all. Between 2000 and 2010, as the number of Chinese loans in distress increased, China became the biggest single player in debt restructuring. However, over the last 10 years, that position has changed monumentally. And you can see that over the last few years, the vast majority of all debt restructurings that are being handled for countries have been managed by China. China is now by far the dominant player in all of these debt negotiations. And this obviously reflects the data that we've just looked at about the amount of loans that China has that are in distress, and also as a reflection of the fact that the Chinese loan book has a much higher credit risk than the general market average. So this table really gives you a good feel as to the weight of the problem that China is facing right now. The huge majority of countries that are in distress right now have debt out to China, and China is having to restructure all of these facilities. And this table provides a really interesting insight into what's happened with the Belt and Road Initiative. The bars show the net financial transfer to developing countries in each year since 2000. And the table shows that between 2004 and 2018, there was a huge net outflow of capital from China to all of the developing countries. Now, these bar charts represent net transfers, so it's new investments into countries, less any principal and interest that's been repaid by other countries. So this effectively shows the cash flow of China over that period. So you can see that China on a net basis was investing tens of billions of dollars over the period. However, it's really interesting to look at what's happened in 2019 and 2020 because there is now a net inflow of capital back to China. So China has been reducing the amount of money that it's actually investing into the Belt and Road Initiative, and at the same time it's been demanding repayments, and the interest has been increasing on all of the loans. Over the last 10 years or so, the total amount of exposure has increased to around $1.3 trillion, and now China is taking money back from all these developing countries to pay itself interest. So in theory, as a lender, this should now become the profitable period for China. They've made all of their loans, they should be sitting back and taking the interest and repayments on those loans and becoming cash positive. But the problem that China has is obviously a lot of these loans are now in distress, the credit ratings have fallen, it's likely that many of the countries will not be able to make the interest or the repayments on these loans. And so although theoretically China should be getting a lot more money coming back in reality, it's likely that they won't get that cash because these countries just don't have the capital to pay it. And as I mentioned earlier, you then have that $64 million question as to what's China going to do. Are they going to put more money out the door to finish these projects and then get them to the point where they can generate revenue to make repayments in the future? Or are they going to walk away and leave these projects half built? Now, as I mentioned at the start of the video, one of the surprising things is that China has been investing a lot of money into Russia through the Belt and Road Initiative. It's been reported that over the last 20 years, China has invested around $300 billion directly into Russia to develop energy and infrastructure projects. And this table shows a breakdown of the investments that have been made over the last 8 years. And you can see that up until 2019, China was still investing heavily into Russia. However, over the last couple of years, that investment has fallen significantly, and the vast majority of the money that's been spent has been on construction. And as I mentioned earlier, a lot of the construction projects are built by Chinese companies using Chinese employees. Now, there's been a really interesting development in terms of Chinese investment into Russia since the start of the Ukraine war. It's been reported that no further investments have been made, and China has now started to divert funds to Saudi Arabia and Iraq, who are two other oil-rich countries that are looking to develop their natural resources further. In the first half of 2022, China agreed deals in Saudi Arabia equating to $5.5 billion of investment. And in 2021, Iraq was the single biggest beneficiary of Belt and Road investment with $10.5 billion worth of contracts signed. So this is a really interesting development, because what we're seeing here is that China is moving away from Russia. It's pulling back from its relationship and looking to other countries who can provide it with ongoing sources of oil. Now, this is a really fascinating move, because if you've been following the channel, you'll know that a lot of people have been assuming that as Russia moves away from its ties with the West, it will turn to China and India and sell huge volumes of oil directly to both of those countries, and that will make up for the lost business from the West. However, if China is now deciding that it doesn't want to carry on with those relationships, then that would leave Russia high and dry. And of course, China has invested around $300 billion, and Russia, as a credit risk, has deteriorated significantly since the start of the war. Russia has defaulted on its international debts and has been downgraded by all of the rating agencies. So from China's point of view, their biggest single exposure is now at risk of going very bad. And that could be really bad news for ongoing Chinese-Russian relations, and fundamentally could be a disastrous position for Russia to find itself in, because at the time when it wants to reach out to China to strengthen the bonds, China may well decide that it wants to walk away and develop relations with other countries. So what's the summary and conclusion today? Well, I wanted to post this video because it's really interesting to see what's going on with all of the debt that China has put out of the door from the Belt and Road Initiative. The investment into all of the different countries, all of the emerging and developing nations, has been done predominantly by debt. This isn't a benevolent investment. This is a commercial agreement that China's put in place with all of these countries. So those facilities have interest that has to be paid on the loan, and the money will need to be paid back. And what China is finding right now is that more than 60% of all of those loans are in distress and are going bad. They've been lending to high-risk nations, and those nations are not in a position where they can pay China back. So the $1.3 trillion of exposure that China has right now is in serious jeopardy. But it's not just the debt that's a problem for China. A lot of these projects have not been finished. So they've been teaming up with a variety of different countries to work on energy projects and other forms of infrastructure. They've been using Chinese companies to construct these projects. And if the projects go unfinished, then all of that money will be entirely wasted. So China's now in a really difficult position. Firstly, it needs to restructure all of these debts. So it needs to sit down and renegotiate the position with every single country around the world. And that is a huge task. That is going to be a monumental effort. But secondly, the net outcome of all these negotiations is likely to be that those countries need more money to be able to finish whatever project they're working on. So it might be a power station, or it could be an oil plant, or it could be an airport or road transport or anything. And if these things remain unfinished, then they'll be worthless to that country, and there is no chance of China ever recouping its capital. So China, realistically, is likely to have to put more money into these countries, and that's always a very difficult decision to make as a lender. Do you want to give that borrower any more money, or do you just want to walk away and cut your losses? And the problem that China has right now is that its exposure globally is massive. It's lined up a lot of the infrastructure in terms of the companies who are involved in those contracts. So it's not just the overseas entity that has an impact. It will be the Chinese companies who've been relying on this state-funded form of business coming through. So if China walks away, then all of those companies will no longer have that guaranteed source of business. And of course, all of this is coming at a time when the Chinese economy is in distress. So China doesn't really have a huge pot to be able to start spending money on lots of overseas investment. So this is a nightmare for China, and it's likely that it's going to get much worse. The invasion of Ukraine by Russia has caused the whole of the globe to go into crisis. We've seen an increase in the price of everything, and that's putting more pressure on more economies, and it's likely that we'll see more and more of these emerging and developing nations going into distress. So there's a real chance here that the vast majority of China's loan book will go into distress. Those companies won't be able to make the repayments, and then China will face the prospect of having to write it off or follow their money, to put more money into those deals. And that's going to be a really big decision to make. So I think the overall summary here is that the Belt and Road Initiative has not been a success for China. It's left it with a huge exposure to lots of countries whose creditworthiness is falling, who are unlikely to be able to make any repayments. And China is going to be left with a whole lot of bad loans and bad debts and massive losses. And this could have a catastrophic impact on the Chinese economy.
So hopefully you found today's video useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end. And here's something to put a smile on your face.